I'm Anna Wichman of Capital Link. Welcome to Capital Link's Expert Talks podcast series, which provides expert insights on a variety of topics relevant to the shipping industry. We are joined today by Jim Cirenza, Managing Director of DNB Markets, a leading Nordic investment bank with a global presence. Today, Jim will give us an update on the latest trends and developments in the U.S. capital markets. And with that, I turn the floor over to you, Jim.
Thank you very much, and good morning, everybody. Could you change the slide, please? So if we look at the markets, and I just want to make a point as to how correlated so many markets are. If we go back to July the 10th, the NASDAQ 100 made an all-time high, the NASDAQ made an all-time high, the Magnificent Seven made an all-time high, the Japan's Nikkei 225 made an all-time high, and the yen troughed at 162. And if you look towards the right-hand side of this chart, which incorporates into the beginning of August, when we had that August 5th meltdown in the market, and if you'll turn the slide one more time, please, you can see how correlated these markets have been. So you have an issue with the biggest concentrated long position, which is technology, and in particular US technology, and specifically some of the technology stocks and communication stocks within the Magnificent Seven. And you had a concentrated short position emanating from the carry trade with the Japanese yen and the Japanese JGB, and both triggered at the same time, both in terms of their highs and also in terms of their sell-offs. But I don't think that this rotation is done. So what does it mean for the rest of the market? And if you'll just change the slide again. And this is what it meant short-term to high-yield spreads. As we look at the various markets, the NASDAQ and the tech segment of the market have yet to get back. Despite yesterday's rate cut and despite today's rally, we're still about 4% away from where we were back in early July on NASDAQ. If you look at the various markets, the treasury market would indicate that there's a probability of a hard landing. The commodity markets, in particular, the energy markets and metal markets, would indicate that there's a probability of a hard landing. And then if you look at the credit spreads, other than the blip that we had higher in early August, credit spreads have returned to where they were prior to that. And so we're not seeing any real widening in the curve. And so the credit markets are suggesting a soft landing, and the equity markets with the S&P back to an all-time high this morning are suggesting maybe no landing at all. So the various markets are interpreting the economic outcomes very, very differently at the moment. Please change to the next slide. As I look at what's happened to NASDAQ, the Magnificent Seven, the Nikkei 225, the yen, as I look at what's happened, it's created a very important rotation. We now have S&P back to a high. We've got the Russell 2000 back to higher levels than we've seen in the last 2 years. Not quite back to where we were 3 years ago. And so we've got a rotation that I think is underway away from these expensive technology and communication stocks into more of the value stocks, which certainly incorporates things like, shipping, industrial, energy, etc. If you look at how clients are positioned, first we'll start with the average retail client. And the average retail client in August had 70% of their money in equities. That's about as high as it goes. If you think about the guided 60-40 model, with 60% of your money in equities and 40% of the rest of your money in bonds and cash, it's left investors with lower cash levels than usual and lower bond holdings than usual. If we go to the next slide, and this is a more complicated slide looking at how institutional investors are positioned. Bottom line is institutional investors in the beginning of July were well over the 90th percentile in terms of equity ownership, and in particular as it relates to the technology stocks. Next slide, please. If you take the highlights of the Merrill Lynch Fund Manager Survey, we've had institutional cash levels for the last 3 months roughly at 4%. And if you think about the 25-year range of where institutional cash has been within their portfolios, the range has been anywhere from 3.5% to 6.5%. And so 4% is on the low side. Next slide, please. The point that I'm making is that investors have a limited amount of cash to put to work in the markets at this point in time. Individuals are more or less maxed out in equity ownership, and institutions, certainly back in July, were maxed out in terms of equity ownership. And so in order for the broader market to perform well, the expensive stocks, which include Japan's Nikkei and includes the Magnificent Seven, the expensive stocks need to roll over for the rest of the market to do well. If I think about money flows broadly, to me it begins with the central banks. And the central banks drained money from the system in 2022, but on balance surprised us in 2023 with an injection. And so if we just flip through these next 3 slides, between the Bank of Japan, the Federal Reserve, the ECB, and the Bank of China, collectively, we had a positive surprise in 23. And collectively, the Bank of Japan, although their balance sheet is going sideways, all these other balance sheets are going lower. And so the liquidity provided to the system is tighter than what we've seen since 2022. Next slide, please. If I look at what happens when the Fed creates an economic slowdown, and the Fed has created a recession and a bear market in 3 occasions in the last 50 years. It happened in 1973-74. It happened with Paul Volcker in 1981-82. And it happened with Greenspan back in 1991, which was the smallest of the recessions. So when the Fed creates an economic slowdown, what tends to happen is three things move. The first thing that moves is the interest rate sensitive part of the market, which is featured here by mortgage applications in the US to purchase a home. Mortgage applications to purchase a home during this past summer was the lowest volume in almost 40 years. And if you go back 40 years ago, there were half as many homes as we have today. So when you hear people talking about the housing shortage and the housing crisis, this is an important driver of economic growth. And to see housing formation as low as it's been for the past 2 years is one of the concerns. So the interest rate part of the market has certainly been damaged by these high rates over the last 2 years. You see it also in the M&A market, where M&A activity in the last 2 years is the lowest that it's been in the last 12 years, which is also a very interest rate sensitive market. So the 3 pieces of this are the interest rate sensitive part of the market gets hurt first. The orders get hurt second. We've certainly seen them with ISM manufacturing orders, much less so with services. And finally, the last piece of the puzzle that comes under pressure is the employment piece, which is obviously part of the Federal Reserve cutting interest rates yesterday. Next slide, please. As I look at the US market, and I look at it from a variety of valuation metrics, we're as expensive as we were back in 2000. We're more expensive now than we were in 2008. In terms of enterprise value to EBITDA, the US market's trading over 15 times. When we peaked in the year 2000, it was only trading at 14 times. So the US market is expensive. If you look at price earnings, we're trading at 21 times earnings, clearly higher than any other market in the world. And if you look at price to book, the US market is trading at 5 times price to book. So this notion that the market isn't expensive is wrong. It's only less expensive from a price earnings point of view on a relative basis, but the market is expensive on virtually every metric. Next slide, please. So if you look at the 11 S&P sectors, there are 3 over the last 2 years that have really stood out in terms of extreme valuation. So those green bars represent EV to EBITDA. And technology has been in the mid-20s. Communication has come down, but communication was in the mid-20s back in 2022. And real estate remains elevated. So there are 3 of the 11 sectors that remain elevated. And you look at things like energy, materials, industrials, off to the right-hand side at single to barely double-digit EV to EBITDA multiples. The difference between value and growth in the market is not quite as extreme as it was in January of 22. But in July of this year, it was very close to that extreme. And so once again, this notion that these multiples can continue, to me, is unlikely. And the growth rate of these stocks that we're talking about has started to come down. So if you look at the market last year, you had 8 stocks, the Magnificent Seven plus Pfizer, that represented a little more than 30% of the S&P. Those 8 stocks were up roughly 75% last year, and the S&P was up less than 25% last year. That means the other 492 stocks gave you a return on balance of 0. If you look at the earnings picture, the Magnificent Seven had earnings growth in the fourth quarter of over 50%. And they had earnings growth in the first quarter of over 50%. And they have earnings growth now in the second quarter of 30%, and consensus estimates believe that the earnings growth for these stocks will be 17% in the third quarter. So the domination of the market by the small number of stocks, I think, is over on a relative basis. I think the rotation that we've started to see over the past 2 months, 2.5 months, I think that's going to continue, and I think it bodes well for the companies that are involved in the sectors that we care about here. If you go to the next slide, and you look at how the US market is valued versus everything else. So if I start with price to book in the US is 5 times. Price to book in UK and Europe is roughly 2 times. And price to book in China and Hong Kong is less than 1.5 times. The price earnings in the US at 21 times, and it's not my favorite metric. The price to earnings in the US at 21 times is 50% higher than the price to earnings throughout most of Europe, and almost a double the price to earnings out of the UK. So the valuation gaps and EV to EBITDA is just one more measure on the screen, but the valuation gaps that the US market has over the other countries around the world is the greatest that I've ever seen. I still believe that the US is by far the greatest listing venue for any public company. You've got the most liquid capital markets. You've got the biggest investor base. If you're lucky enough and large enough to have index inclusion in your future, you've got the advantage of passive money as well. That being said, I find it difficult to believe that there's any further growth for the US relative to the rest of the world. If anything, I would expect there to be some contraction of this valuation disparity over time. Next chart, please. So there's the disclaimer. And as I think about the capital markets now, and I think about the energy related companies, and I think about the shipping related companies, and from DNB's perspective, we're focused really on three sectors, and the third sector being healthcare. We've been involved in parts of the capital market that haven't seen these excess valuations. We've been involved in parts of the capital market where the capital raising has been more difficult than other segments. And we've been involved in parts of the capital market which are clearly interest rate sensitive, although the shipping industry, having paid down so much debt in the last 2 years, is even though it's a capital intensive industry, it's much less interest rate sensitive than it used to be. But I'm optimistic that as we go forward, and we're sitting here today with an S&P at an all-time high, NASDAQ's about 4% away. I'd be very surprised if we return to those highs. Tomorrow's an important day in the markets. You've got triple witching tomorrow with about 5 billion of options expiration. And if I look back over the last 35 years, the September expiration is a dangerous one, and the volume of calls that are expiring outweigh the volume of puts that are expiring by about 4 to 1. And if I look back over the last 35 years, in 31 of these 35 years, the market traded down the week afterwards. And so I don't want to get too caught up in the short-term euphoria around yesterday's rate cut and the new high in the S&P today, and focus more on what I think is going to be a rotation into sectors and into stocks that make sense for what we focus on day to day and what you focus on day to day. I thank you for your time and hope to see you again soon.
Thank you, Jim, for the presentation and your insights. And thank you everyone for tuning in. Please look out for upcoming episodes in the Expert Talks series, which will shed light on critical aspects of the maritime industry. As a reminder, this podcast is for educational and informational purposes only, and does not constitute investment advice or advice of any kind. Thank you.